Welcome back to another Millennial in Debt video. If you are new here, hit that subscription button below and turn on the notification bell so you get every single time I upload a video. It's technically Stock Tip Tuesday, so we're going to be talking about all things stock market. And like the title suggests, this is how to become a millionaire. I already call y'all future millionaires, so I figured I'd show you how to get there. All right. So in order to become a millionaire in the stock market with as little volatility, because there's always risk involved, right? It is really in your best interest, if you want to be a long-term investor, to look into index funds. Now, I've talked about index funds a couple of times on Instagram, and if you're not following, why is a party over there? Right? I have talked about them, and I've explained them essentially to be a giant pizza pie that incorporates all different stocks from all different sectors of the stock market in order to make it less tricky for you to pick, like, oh, I'm going to pick one individual stock and hope that it really does well, or pick this individual stock because it's booming now and hope that it continues to grow. That's too much risk. My anxiety really just is not built for that type of investing. So I prefer low cost, low fee index funds in order to help grow my money. So in about 20, 30 years, I could be, chilling like a millionaire on a beach as a millionaire, not like a millionaire. As a millionaire. And so the index funds that I am going to mention here, some I do invest in, some I don't, but I've been really interested, I've been intrigued. And that does not mean, and I want to be very clear, that does not mean that I'm telling you to invest in these stocks and they will guarantee you money, because that is not true. No one can guarantee you anything in the stock market. And so we're going to just get that little legal spiel out of the way. Now, this is just advice. These are suggestions based off trajectories and based off past performance. Nothing's guaranteed in this world. Let's get into it, right? So like I mentioned, an index fund, or when you purchase one index fund, you are getting a pizza pie or a diversified amount of stocks in one purchase. So if you're really interested in stocks like Apple or Tesla, Amazon, but you don't have the capital to buy an actual full stock because some of these stocks are very expensive, or you're still a little like, well, this is really risky, I don't want to just jump in there and then the stock tanks, and so it's a lot when you're just getting into the investing world. So instead, you want to go into index funds. Now, index funds are also passively managed, and if you don't know what that means, you can click that little link up top that compares active and passive management, which would be index funds versus mutual funds. And if all of these definitions and words are like very new to you, you can also click this link up here, which will walk you through the ABCs of the stock market. I got you covered. We're besties at this point. So if you're interested in investing into index funds and you're like, well, where do I start? I don't really know what to do. You're going to need a brokerage. So the brokerage that I use for investing with index funds, on an individual basis, I guess, is E-Trade. And then what I use for my Roth IRA, which I still also invest in index funds, is Vanguard. So those are the two brokerages that I use. I have used Robinhood in the past, and I talked about why I left Robinhood. And if you didn't catch that video, you can catch that up here too. And I've heard really fantastic things about Fidelity, Betterment, right? If you're looking for Robo advisor. So there's a ton of different options that will fit any of your financial needs when it comes to investing, right? So that's where you start off. Once you've got your brokerage, you're just like, okay, how do I pick an index fund? You want to look into what that index fund covers, because different index funds will be a part of different indexes, right? It could be a part of the NASDAQ, part of the Dow Jones, a part of the S&P 500, which is a really popular one for people who are getting into index funds. So when I talk about specific index funds, I will give you the ticker symbol, and we'll go over, the fees and all these things, and then the different types of companies that are involved in that index fund. Are you ready? I'm ready. I said a lot, but I'm ready to go. I just want to make sure you're ready. The first index fund that I am going to discuss is the Vanguard S&P 500 index, and that ticker is VOO. People love VOO, and by people, I mean me. VOO is one of the pricier index funds. It is trading at about $335 as of today, which is January 9th, right? So by the time you see this video, it could be trading at a higher or lower cost. And now what VOO does is it exposes you to 500 different companies. So when you buy a VOO index fund, you are being exposed, your portfolio is being diversified into 500 pretty much American-based companies. Now, VOO is a large cap blend. So what I mean by large cap, because I'll also mention small cap in this video, large cap funds or large cap stocks are just what they sound like, really big companies that are valued at over $10 billion. Small cap stock starts at 300 million all the way to 2 billion. And then in the middle, we have mid cap stocks, which I'm not really going to get into. All right. So the VOO index fund really covers large cap stocks. It has a dividend at about 1.6% and it covers about $172 billion in assets. So it's doing its thing. What I like about VOO, although it's trading at about $332 per share, it is a low fee index, which means for every $10,000 you have as a part of your portfolio, you're spending about $3 annually in fees. So it's a very, very, very low costing index fund purchase, which I am thankful for and I enjoy greatly. Now, if you're interested in Vanguard indexes, but $300 plus for a share is like, what? You could also invest in VTV, which gives you exposure to about 300 companies instead of the 500 that VOO does. And they have large cap and mid cap stocks. So things like Johnson & Johnson would be a part of that, whereas opposed to VOO has Apple and Exxon and Chevron, but they have a lot in Apple, which is not a bad thing, as of right now. But I like for my index funds to be diversified in the weight of how much, they have in each company. So that is something you definitely want to look into. VTV also has a low expense ratio, so you won't be paying too much annually if you do invest in that particular index fund. Schwab US Small Cap is another really popular index fund that's going for about $86 a share. It has a 0.04% expense ratio. So again, about $4 annually for every $10,000 you have invested in that particular ETF. Now, when you're looking at small cap, people are thinking, well, I should invest in large cap, right? Bigger company. Well, this particular index fund does have about $12.5 billion in assets, and small cap funds tend to, again, this is all based off historical facts, historical experiences, whatever, right? Small cap tends to do better when the economy is picking back up, and many finance people are hoping that in 2021, with vaccines coming out and all the things of people getting back outside and spending, the economy is going to have a boom. So a lot of small cap stocks are looking very, lucrative, and people are keeping their ear to the street, or their ear to Wall Street, I guess. Now, the industrial sector. So there are 11 different sectors in the stock market that pretty much, cover all of the companies that are part of the New York Stock Exchange. And so the industrial, and I'll look it up so I don't, give you the wrong information. The SPDR, so that is the industrial sector, and you're getting really a lot of exposure to like aerospace and machinery when you're investing in this particular index fund. And it has a 1.6% dividend yield and a little bit higher expense ratio at 0.13%. But again, these are all very low, because I've seen some expense ratios that their fees are like, I don't want it. It's just no. It's just a no. The next ETF that people are looking into for this year is John Hancock Multi-Factor Consumer Discretionary. It is long. Its ticker is JHMC, and it's trading at about $44 as of today. It does have a slightly higher expense ratio at about 0.4%, with a dividend at 0.9%. Now, what I like about this is it's $44 a share, so it's very, beginner friendly, and you get access to Tesla stocks, McDonald's, Home Depot, Amazon, and it's weighted a lot more balanced than VOO. So that is very interesting. And again, because, vaccines are coming out and things, and people are being very hopeful that 2021 will return to some sort of semblance of normal spending and normal, human interaction, they're really making on consumer discretionary funds, like, people spending money, extra money, because 2020 extra money really wasn't a thing, was it? Fidelity Zero Large Cap Index Fund. It's making a name for itself. It is a zero fee ETF, and it is owned by Fidelity. So what does that mean? That means it's not technically tracking the S&P 500 like the other index funds that I mentioned. It is tracking the Fidelity Large Cap Index. I know it sounds a little confusing, but it definitely makes sense. And it's definitely fascinating because, again, zero fees and owned by Fidelity. Interesting. So I don't own this index fund because I use Vanguard and E-Trade, and I believe you can only purchase this particular index fund if you have a Fidelity account. By the time I upload this, I will know for sure. So it'll be a fact whether or not you can. Now, why is this interesting? Why is this important? It's because Fidelity doesn't have to pay the fee to S&P, like the licensing fee. So that's really the only big major difference. But this index fund is so user-friendly and so beginner-friendly. It is definitely one that is worth looking into if you're trying to get your feet wet into investing in index funds. And then the last index fund, because I couldn't do an index fund video without mentioning the original S&P big daddy of them all, and that is the SPY. And it's been out for quite some time. It has an expense ratio of about 0.9, which means that you're paying about $9 annually for every $10,000 that you have invested. And SPY is currently trading as of 2/52 January 9th for $381 with $349 billion in assets. So it's definitely worth looking into if you want to, get in there. Now, what's also really interesting, and then I'll end the video because I don't want to make it too long, you can get into index funds that cost a little more, like I said, VOO and SPY are, over the $300 if you're using a brokerage that allows you to do partial shares. If you're using a brokerage that allows you to buy partial shares, then you definitely can still buy VOO and still buy pieces of SPY without spending over the $300. And then also looking into the more affordable index funds that I mentioned earlier in the video. Bye, thanks for watching and see you in the next one.